Hi, I'm Eddie Sanergy, and welcome to Your Finance TV. It's Friday, so what does that mean? It means Jay Pelosky's with us. Jay, how are you, sir?
Marty, great to see you. A little bit of a surprise. I thought it was going to be your colleague, Mr. Duxbury, today.
I know we're mixing things up yet again. So, you get my charming company, got the English accent versus the Australian, so it keeps everyone on their toes. Lots
Exactly.
to talk about as usual in your Friday musings. But before we get in there, to our viewers, don't forget to like and subscribe. It's down there. We're through 3,000 subscribers. Thank you very much for your support. So keep adding day in, day out, week in, week out. So Jay, been an interesting week, and you've obviously published your musings, and I love the title, "Coincident, Not Coincidental." So why don't you run us through your thought process behind this wonderful title?
Yes, well, thank you, Marty. I appreciate that. It's somewhat an erudite one, and I'm not surprised at all that a guy like you picks up on it. But yeah, it's funny. It's another one of these. I've been kind of having it in my mind for a while, and it comes really from some recent observations across the global macro space, both markets and economies. And I guess one way to kind of sum it up would be to just remind us of how the leading economic indicators, right, the conference board's leading economic indicators have been pointing down for roughly like 15 months, one of the longest streaks ever. And it's never occurred without a recession. And at the same time, you have the Philly Fed's state coincident index, which measures the coincident activity in every state. All 50 states have been improving over the last 3 months. So we've had so much talk about recession, and yet now we see people finally fading the recession call, right? Goldman went out and cut its odds of a recession to 1 in 5, which is essentially what the odds have been over the last 100 years have been 1 in 6. So basically people are saying, okay, it's a toss up. And so it really kind of crystallizes in the difference we've seen between hard economic data and soft economic or consumer sentiment or market sentiment surveys, right? So the surveys have been, miserable. People have felt unhappy about inflation. They've felt unhappy about jobs. The market has been unhappy about the market moving up, or at least investors have been, right? Sentiment until very, very recently has been quite negative. And so it really struck me that you have this disconnect between the positive reality demonstrated in hard data, right? Like most recently, the CPI and PPI, or the housing data, or even the economic growth data. The Atlanta Fed is now saying Q2 is going to be growing 2.4%, quite a ways away from recession, and that negative sentiment, which has served, as we know, for risk assets to be kind of the kindling, which has led us to one of the best starts of a year, for one of the best first halves we've ever had. And so to us, the question is, does that continue? First, we want to identify it. And so I even went to the dictionary, right? Looked up coincident, which, just to make sure I get it right, means occurring together in space or time, versus coincidental, which means resulting from a coincidence done or happening by chance. So our point is that the good risk asset performance, which we've been articulating, right? We've been fully invested, we've been constructive for the last 9 to 12 months. So we've captured a lot of this. And our point is that that performance is coincident with good data, and we think it's going to continue. And it's not by chance, which would suggest, if it were, that obviously there'd be risk of it reversing. So long-winded, but it's a title that deserves a little bit of an explanation.
No, absolutely, and that's a great explanation. And if we're, I don't want to say sidelining, but if we're talking about recession, we're semi putting that in its own little 20% box at this point. That leads us to the next questions. What about earnings? What about growth drivers? What are your thoughts on this side of things?
Yeah, that's perfect, right? Because that's another one of these hard data opportunities that we're getting right now. Companies are reporting, and it's also it's the same kind of mentality, though, right? We are looking to see how companies report, we in the market, but more importantly, particularly here at TPW Advisory, we really pride ourselves on focusing forward, right? Looking forward, trying to sniff out, like the market, which is a forward-looking discounting mechanism. We want to try and look forward. So we're A, paying a little bit of attention to earnings, but B, paying a lot of attention to what companies are saying about forward guidance, right? How they see the second half of the year playing out, and what's the early read into 2024. Because as we know, when the sell side and Wall Street kind of comes back from vacation, we were just talking, right? You're heading off to Paris. I'm going off on vacation in a week or two. When people come back, the focus shifts to that out year, right? So we're already starting to really think about 2024. And for us, the big driver, you mentioned, kind of growth drivers. For us, the big driver continues to be that we're in a high nominal growth world. This has been the thing that has supported earnings, right? If you think about inflation plus real growth, so Atlanta Fed at 2.4%, inflation running over the second quarter at about 3 to 4%. You put those two together, that's nominal growth of, let's call it 6%. It's really hard to have lousy earnings when nominal growth is 6%. Because remember, corporate earnings and corporate revenues are in nominal dollars. And so this is one of the major differences that we see continuing as we go into 24, 25, and 26, is that we're not going back to the 2010 to 2020 low nominal growth world, right? 1%, 2% inflation, 1 to 2% growth. No, we're in a high nominal growth world with slightly higher inflation driven by deficit spending, driven by public and private investment to deal with the 3 C's of COVID, climate, and conflict. And so when we look at things like Bidenomics or the new industrial policy in the US or its equivalent in Europe, what we're seeing is really interesting. And we're going to write about this in our next monthly, is kind of almost a competition to see who can develop the best EV supply chain, who can develop the semiconductor chips that are going to drive AI, right? So we're seeing the 3 regions in our tripolar world, Europe, Asia, and the Americas, really starting to compete on this stuff. And that suggests to us that we're going to have a sustained period of high nominal growth, driven in large part by a global CapEx boom as the 3 regions compete to set up their regional supply chain for the EV, for the climate mitigation, and for semiconductor and tech security. And that's really something that we think is going to be very powerful. And people are getting a sense of it now, right? You hear people talking about manufacturing, construction, things of that nature, which we've been talking about for 6+ months. Now it's finally percolating into the general conversation. But to us, this is the key driver, this new industrial policy. We're in a new environment of public and private spending that we think is going to sustain global growth over the next several years.
So Jay, thank you for running us through that. That kind of ties into something we discussed a couple of months ago. We'd started Conversational Rotation, how to better position yourself.
Yeah.
What are your thoughts on this? Because it feels like a perfect time for a bit of a refresher in all of this.
Yeah, and we don't usually want to pat ourselves on the back, but we'll give ourselves a little one for titling a musing. Exactly 2 months ago was May 19th. Today, July 21st. 2 months ago, we published a musings with the simple title Rotation, because we thought that was really the key driver, right? Everyone was and still kind of is talking about the Magnificent Seven and how there's only a few stocks going up, which is completely and utterly incorrect, right? Because what we've had over the last 2 months is a major rotation into the cyclicals in the United States. and into parts now of the emerging markets over the last month or two. And then really recently and very exciting is a move into commodities, right? And there's almost a little bit of a shift from digital to physical. And so when we wrote that Musings piece on rotation, and subsequently over the last 2 months, we've talked about the rotation within US equity, rotation global equity, rotation across assets, and rotation from digital to physical, really talking about some of the barbell strategies that we've been employing in our two model portfolios, right? We have our global multi-asset and our TPW20 thematic model, which really focuses on future tech and climate. So that's been really interesting because future tech, all the AI stuff has just rocketed and climate's really struggled. But now what we see is some profit taking, which we talked about a few weeks ago. Not a bad time to take some profits on some of the aggressive moves in US tech and rotate that into either parts of the emerging market equities or into the commodity space. And so what we're seeing now is that move into commodities. And I'll just give the viewers, two examples of this. So the first is that the Goldman Sachs Commodity Index, the symbol, the ETF is GSG, is just finally breaking out above its 200-day resistance level. And we are not technicians, but tend to agree that for the most part, good things happen above the 200-day moving average. So that's important. And it's been driven by WTI, right, West Texas Intermediate Oil, also breaking above its 200-day resistance. And so that to us is A, good information on its face, but B, strongly suggests that there's no recession ahead, right? If commodities are breaking out, highly unlikely you're going to get a recession. So that rotation, Marty, continues. We expect it to continue to play out. And it basically reminds us and reminds viewers that global macro means global and macro means multi-asset. And the world is full of investment opportunities as we look into the next couple of years.
I love that. The world is full of investment opportunities, Jay, and thank you for highlighting that to everyone, because I think people forget. Jay,
we've been, and it's rightfully so, right? Because for the last decade, we've been in a single game, and the only game has been U.S. equity and mostly U.S. tech. It's dominated everything else. You look back at any 10-year, 12-year chart, really since the low in 2009, it's been all the U.S. And that's one of the things that we think is changing, right? We've talked about this now for a year plus, the beginning of the rotation, the transfer and leadership of global equities from the U.S. to the non-U.S. developed and now starting to be emerging markets, right? So last year, Europe outperformed the U.S. This year, Japan, depending on the day, is performing in line or slightly outperforming the U.S. And what's, again, interesting in this idea of the rotation is that the emerging market equities, which have really been kind of left for dead, are starting to percolate a little bit. And so EM percolating, commodities breaking out, all that suggests to us that this idea of rotation and opportunities outside the U.S. Is very, very real and just getting started. Just getting started.
Just getting started, and lots to see and learn about. Next week's a pretty important week for across the board. We've got it seems central bank week is next week. We've got the ECB, we've got BOJ, but the one that we really care about, the Fed. What do you think is the Fed's going to do next week?
Well, Marty, I don't like to disagree with you, and I'm not really going to disagree with you, but we think the Fed is increasingly of less importance. We think the Fed is effectively done tightening. Whether or not they raise rates 25 basis points next week is kind of immaterial, right? It's fully priced in. So if they do it, nothing really is going to happen. If they don't do it, that's probably going to offer some near-term upside for different things. But the more important point is that the great rate tightening cycle of the last 2 years is coming to an end. And it's going to be replaced by a rate cutting cycle, which is going to be led by the emerging markets. And so this sets up one of our key investment, what we call mantras, right? So the mantra is Fed on hold equals US dollar weakness, which equals rest of the world equity outperformance and commodity upside, right? Because the dollar going down really allows commodities, oil, copper, et cetera, priced typically and still, some talk about it, but still priced in dollars, right? Allows, as the dollar comes down, that's basically a price cut. And so commodities tend to go up in price to offset that. And so that's really what we're looking for. And again, it's starting to play out. Markets are sniffing this out, right? The global economy is on an early cycle recovery. Commodities breaking out is supportive of that. EM equity starting to move higher is supportive of that. And so we think the Fed is kind of immaterial. The ECB is going to raise rates, but it's really interesting to actually note how fast inflation is now falling in Europe. And inflation expectations in Europe, Madi, have completely collapsed. And so we're starting to toy with the idea of a soft landing in the global economy, but a hard landing in developed market inflation, right? And so this is something, again, we're just starting to think about it. What we have come to conclude is that inflation has been a developed market, developed economy issue. Because if you strip out some of the real outliers like Argentina and Turkey, emerging market inflation right now is running at about 2%. So there, and the poster child for this is Brazil, right? Which, I started my career in Brazil back in the day when it was hyperinflation. Well, today, Brazil has lower inflation than Germany, right? You and I, we always grew up with the Bundesbank and, the Deutschmark and hard currency and no inflation. And today, Brazil has less inflation than Germany, which is pretty wild. And so we expect, as the Fed goes on hold, that sets the stage for emerging markets to start to cut rates because they raised rates well ahead of the Fed. And so they started the rate hike cycle and they're going to really start the rate cutting cycle. And so we're looking really to finish up here on two things. One is China, right? So you mentioned Bank of Japan. That's going to be important for Japan, right? We're very bullish Japan. Whether they make a move on yield curve control this next week or in the next couple of meetings remains to be seen, but I think that's the direction. They're going to adjust yield curve control. They're happy with some inflation. In China, no inflation, PBOC cutting rates, and we're looking for some additional stimulus out of China with their Politburo meeting also happening next week. And just to give you a sense of how far down China has fallen, we put some numbers in the musings. The underperformance of China equity versus the rest of emerging market equity is 16 percentage points, the widest underperformance in over 20 years. And meanwhile, the Chinese yuan is trading at a similar 16-year low versus the other emerging market currencies. So China has been kind of really left for dead here. The sentiment is just super horrible. So we think there's an opportunity brewing there as they shift and drive some stimulus. And then secondly is that commodity segment, which we talked about a little bit earlier. Dollar down, commodities up, breaking out right now. So we continue to like energy and industrial metals, particularly copper, for the second half of 2023.
That's fantastic, Jay. And that's really interesting about China. I didn't realize it was 16%. That's quite a statistic.
Yeah, I mean, whether the exact number is not.
No, but it's a big number.
Yeah, right. And the sentiment about China is like the sentiment towards equities, 6 months ago, right? Because nobody wanted to own equities. Nobody wanted to admit owning equities. And now China is just like, oh, their growth is lousy, their policy is lousy, this, that, and the other thing is lousy. We're going to freeze our relationship with them and all this kind of conversation. The reality, again, hard data versus sentiment. Hard data is that China, which is an economy that is almost the size of the United States, is going to grow twice as fast as the US, twice as fast as Europe this year. 5% growth. And yet people can't be bothered to participate in it. So to us, we think the economy is going to pick up there in the second half of the year. We think the policy measures to stimulate consumption are going to materialize and kind of catch fire. There's been a lot of small movements made, small policy adjustments made. We're expecting some bigger ones this coming week or two. But the reality is that China has almost been written off. And, you're writing off an economy that's the second biggest in the world, growing at 5% per annum. Doesn't really make a lot of sense to us. And so we see, again, that commodity breaking out above 200-day resistance levels, kind of in line with the idea that China is going to grow and do better in the second half of the year. Those two things very consistent, and that supports the idea of early cycle global recovery, US and Europe coming behind Asia, Japan, China, Southeast Asia leading the global growth recovery, Europe and the United States kind of following along behind.
Jay, certainly can't write off China, and you shouldn't. So, if I want to learn more about Jay Pelosky and TPW Advisory, Jay, how do I get your content?
Well, you just go right to Pelosky.com, and it's all right there. You can sign up for our musings, learn more about our model portfolio delivery service, and reach out to have a discussion, which we're always open to do. We're always happy to talk to folks, always happy to bring new clients on board.
Fantastic, Jay. Thank you for sharing your thoughts and your musings as always. We'll catch you next time.
Great to see you. Enjoy Paris, my friend.
And enjoy your camping trip. We'll be back next week. And until then, good luck investing.